Welcome to today's program, brought to you by Wall Street Alliance Group and Medical Economics. My name is Chris Mazzolini, and I'm the Editorial Director of Medical Economics, and I'll be the moderator for today's webinar. We have an exciting program that will help physicians plan for a successful financial future. Joining me today are Syed Nishat and Aadil Zaman, partners at Wall Street Alliance Group. Their articles and interviews about physician asset protection, wealth building, and retirement planning have been published in Medical Economics, Medscape, and MedPage Today. Syed and Aadil are regularly quoted and interviewed in prominent media outlets such as Forbes, U.S. News and World Report, Bloomberg, Yahoo Finance, and of course, Medical Economics. You can find more information about Wall Street Alliance Group online at wallstreetag.com. During today's event, Syed and Aadil will focus on tax and estate planning, an important topic as President Joe Biden is considering a substantial tax hike proposal. We'll delve into this plan and analyze what effect it could have on tax and estate planning for physicians. So just a few notes before we begin. This webcast is designed to be interactive, and we encourage you to submit questions using the Q&A tool underneath the video player. We'll try to take the last 10 or 15 minutes of the program to answer audience questions. The slides that you see on your screen will advance automatically during the event. Finally, if you are having problems viewing or hearing the webcast, click on the support icon to report your issue. So now let's get going. Syed and Aadil, thanks so much for joining us today.
Thank you for having us.
I'll start with Aadil. Can you please explain President Biden's tax proposal and how it impacts physicians?
Great to be with you, Chris. So, we at Wall Street Alliance Group, we do wealth management for physicians. And, first of all, I'd like to start by thanking all the physicians on this broadcast who are on the front lines of this war against COVID-19. Thank you for your service. So we do wealth management for physician families, and we provide full 360-degree solutions in a fiduciary capacity, ranging from tax planning, estate planning, portfolio management. And we have a team of experts from attorneys, actuaries, and CPAs who we collaborate with to provide these solutions. Right now, a hot button issue for us, Chris, has been Biden's increased tax proposal, which has a significant impact on physicians. Now, the biggest impact that this proposal has is on people that are making more than $400,000. Now, as you know, Chris, a lot of physicians do make more than $400,000, so they are, in fact, impacted by this, especially if husband and wife together collectively easily go above $400,000. So the first item on this list is what he wants to do is he wants to raise the top marginal tax rate for those making more than $400,000 from 37% to 39.6%. Now, some folks might think that, hey, it's just a 2.6% increase. It's really not such a big deal. But let's take a step back. That's actually not all. The second part of this is that, we pay Social Security tax on income up to $140,000. Anything above $140,000, we actually do not pay any Social Security tax. So what Biden is proposing is that for those making more than $400,000, on the portion of the income above $400,000, there would be an additional 12.4% Social Security tax. In addition to that, when we take our deductions on our tax returns, we have two options. Either we can take a standard deduction, or we can take something which we call as itemized deductions. So for those physicians that are listening to this broadcast today that are self-employed or that have their own practice, for them, the itemized deduction makes a lot of sense because they have a lot of expenses. So what Biden wants to do is that for those making more than $400,000, he wants to limit the itemized deduction, phase out the itemized deduction. Now, the second part of this is impacting people that make more than $1 million. Now, as you know, a lot of physicians, we have clients that are oncologists or interventional cardiologists. Their earnings tend to go above $1 million. Now, for those folks, what's going to happen is that the capital gains tax rate is going to go up the long-term capital gains tax rate is going to go up to 39.6%. If we include the Medicare surtax, that's going to be around 43.4%, which is about 20% more than what it is right now. So what does that mean for you? If you make more than $1 million, if you bought a good quality stock, you've held it for more than a few years, you sell it, your tax is now 43.4%. Same goes if you have a house that you've held for a few years and you sell it. Same goes for a business if you've had it for a few years and you sell it. This is a significant tax increase that is going to happen. And Chris, the last important point on this is that if this goes through, this tax increase is going to happen retroactively. So starting from April 28th, so it will impact people starting from this year. So again, it's very important to have planning strategies in place because these tax increases will impact physicians.
Great, thanks, Aadil. The next question is for Syed. Can you discuss what strategies physicians can use to keep their tax bracket low so they're not impacted by a higher marginal income tax rate as well as the high capital gain tax rate?
Yeah, thank you, Chris, for the question, and thank you again for having us. As Aadil very nicely summarized, that people who are making more than $400,000, they will be affected the most. So ideally, you should come up with some sort of strategies where you can have a bigger deduction so your overall income is below $400,000. So the best way we still believe is to accomplish this is when you contribute to a retirement account. Like every $10,000 you contribute to a retirement account, not only it lowers your overall taxable income, but you get a deduction as well. So for example, if you're in a 35% tax rate, we are looking at a tax deductions of almost $3,500. Now, there are different types of retirement account out there, but just to give you an idea how a cash balance plan works, if you are 60 years old and you can contribute in a cash balance plan every year $260,000, and this money is completely tax deductible. So if you're in a 35% tax bracket, we're looking at a tax savings of almost $91,000. But again, this is a good strategy you can use to bring your overall income down to below $400,000. If you don't want to contribute so much money to a cash balance plan, you can also consider opening a SEP IRA. In a SEP IRA, you can contribute 25% of your W-2 wage or $57,000, whichever is less. And again, that will help you lower your overall taxable income. Now, a straightforward IRA account, husband, wife over the age of 50 can contribute $7,000 each. That also helps to lower your income. And HSA account, Chris, this is something is very common. We see physicians through hospital. They have high deductible health insurance. You can contribute into the HSA account $70, $100 for the family. And again, this money is a pre-tax. Now, the beauty of HSA account, Chris, that after the age of 66, you can use this money for non-health related reason as well. So a lot of physicians don't utilize it. So make sure these are the retirement vehicle available out there. Use it to make sure your income is ideally below $400,000.
Great. The next question will stick again with Syed. For physicians who work as employees at a hospital, per se, because obviously many physicians now are employed rather than business owners, what options in terms of retirement planning and financial planning are available for them?
So it's a great question. For physicians who are hospital-based, they should max out their 401k plan and 457 plan. And in both the 401k and 457 plan, you can contribute almost $26,000 over the age of 50. And again, these are pre-tax money. Also, a lot of physicians are not aware of it. There's something called a 409A plan with the hospitals. Not every hospitals allow it, but if you talk to the HR, maybe the option is available. In a 409A plan, you can defer money. There's no match, similar to a 457 plan, but the amount is substantial. It could be almost close to 90% of your W-2 wage. The problem with the 409A plan, like 457 plan, the principal is not guaranteed, just in case if the hospital files for bankruptcy. So we're not suggesting you put a lot of money into it, but at least if your taxable income from other sources are there, consider putting some money away through a 409A plan. Now, Backdoor Roth IRA, this is also is one of the underutilized strategy in the physician community. In a backdoor Roth IRA, you can open a post-tax IRA account, convert the money immediately to a Roth IRA. Remember, in conversion, there's no income restriction. Once you convert it, the money grows tax-free. The withdrawal is also tax-free after the age of 60. And people think, hey, $7,000 is not a big deal, but me and Aadil, we were talking to a client in New Jersey who's a physician, 50 years old, husband, wife, can do a backdoor Roth IRA, $7,000 each, $14,000 in 20 years. If the money grows by 7%, the amount becomes almost $680,000. And again, all this money when during withdrawal is completely tax-free. So again, speak to your financial advisor. If you are hospital-based, about backdoor Roth IRA and all the retirement account the employer offer as well.
Let's stick on the topic of tax deduction and retirement, and I'll keep the question to Syed again. What other tax deduction vehicles are available for physicians besides their retirement account?
Yeah, so besides retirement account, it's not uncommon for a physician to invest into real estate. Buy different commercial real estate property or condo, townhouse, and rent them out. And like Aadil mentioned, that if your income is more than $1 million, we're talking about capital gain tax, like a long-term capital gain tax going up. Right now is 20%, is going up to as high as almost close to 40%. So if your investment, you are doing it into real estate, try to consider investing into opportunity zone. Opportunity zone is something we see for the last few years, a lot of interest. This is in an area where there's a 20% poverty rate, and you can go, before you buy the property, you can ask the agent and they can tell you whether it's qualified for the opportunity zone or not. The beauty of the opportunity zone is once you buy it and held the property for 10 years, there's no capital gain tax. So again, if you're a high income bracket, consider investing into opportunity zone properties. Also, cost segregation, like for physician community, is very common to have their own practice and pay themselves a rent. The issue becomes when you pay themselves a rent, that becomes a taxable income. Cost segregation is a good way to lower your real estate income or passive income. The way the cost segregation works, like if you have a commercial property, the typical depreciation is about 39 years. What it means, the depreciation, that every year, the depreciated amount you can write off from the income you receive from the property. Cost segregation, all it does is lower the depreciation from 39 years to as low as 5 to 7 years. So you get a bigger depreciation. You can use this money to actually offset any income you have from the property. And we were talking to a client in Texas recently who purchased a strip mall for $1 million. We did a cost segregation study. We immediately got to write off almost $250,000. Now this $250,000, this client, any commercial rental income will be coming, doesn't have to worry about paying any taxes. So it's very powerful. If you have your own practice, consider doing some cost segregation to overall lower your income, because the total income, adjusted gross income, is part of the $400,000 the Biden's proposal is. And lastly, charitable contribution. This is something I won't be able to cover the whole thing because a charitable contribution planning could be a webinar of its own. But just to give you an idea how a charitable planning works, rather giving money as a cash and get a deduction. Last year, a lot of stock went up. For example, Tesla went up a lot. So if you own the stock, rather giving cash, give the stock as a donation. In this way, you actually don't have to worry about paying any taxes on selling the stock, and also you get a deduction as well. Secondly, those individuals who are at the age of 72, they have to worry about required minimum distribution. So if you're charity-minded, rather giving money as a cash, gift the money from the retirement account. So in this way, that income will not be part of your adjusted gross income. And lastly, if you're really charity-minded, we can set up a charitable remainder trust. And in a charitable remainder trust, you can contribute this money and get income as an annuity payment as well. But again, I know I briefly summarize it, but this is something that we can talk one-on-one depending on your individual situation. But these are the strategies that are available beside retirement planning if you're looking to overall lower your income and hopefully will not get hit by the new Biden tax law.
Great, thanks for that answer. I just want to pause for a moment to remind our audience that you can submit questions for our experts by typing them into the Q&A box. And of course, you can find more information at www.wallstreetag.com. The next question is for Aadil. Many physicians can potentially face higher income as well as higher capital gains taxes. What are the strategies and vehicles that physicians can use for tax-efficient investment?
So great question, Chris. So obviously, when taxes go up, tax-efficient investments become extremely important. One of the strategies that we used extensively in 2008 was a strategy called tax loss harvesting. And this strategy becomes extremely relevant now as well. And basically what you do is that if you own a stock in a non-retirement account, you sell, which is at a loss, you sell it, you book the loss, and as long as you don't buy it back within 30 days, you can actually take that loss to offset future capital gains. And you can actually buy the stock back after 30 days, or within those 30 days, if you want equity exposure, you could buy something else. But the main advantage of this strategy is that this loss you can keep carrying forward to write off capital gains, which could be potentially taxed at 43.4%. So this becomes a very valuable loss to carry forward, and you can write off this loss against stocks, or you can even write off this loss against real estate gains as well. Municipal bonds become very important. So municipal bonds are bonds that are issued by the state government. And if you purchase a municipal bond in the state that you live in, the yield on the municipal bond, you don't pay federal taxes on that, and you don't pay state taxes on that. So essentially, if you get a 3% yield on a municipal bond, it's equivalent to making almost 5% in a taxable account. If capital gains taxes go up and dividend taxes remain the same, and I want to make some return, if I make it through dividends as opposed to capital gains, I would save about 20% in taxes. So dividend paying equities become very important if this capital gains tax actually goes up. And location of assets becomes very important, Chris. So for example, if I'm going to have two buckets of money, and in one bucket, I'm going to be actively managing it, and I'm going to be selling and booking profits. If I do it in my non-retirement accounts, every time I book a profit, I'm paying 43.4% in taxes. But if I book the same profit in my retirement account, I'm not paying any taxes. So what would make sense for me is that for my retirement assets, I could take a more active approach. And for my non-retirement assets, I could take a more passive buy and hold type of approach. And lastly, Chris, what a lot of people don't realize is that mutual funds pay something called capital gains distributions. These distributions in a non-retirement account, you have to pay taxes on them. And this is something that you have absolutely no control over. On the other hand, exchange-traded funds, ETFs, pay very few capital gains distributions. So for me, if taxes go up in my non-retirement account, ETFs would be preferable to own from a tax efficiency point of view as compared to mutual funds. So again, these are strategies that are available, and listeners should speak to their fiduciary financial advisor to see which one is the most appropriate for them.
Okay, great. The next few questions will focus on estate planning. So let's talk about President Biden's proposed estate planning changes and how they may impact physicians.
So Chris, this is actually really the meat of this. This is really important for folks to understand. So what Biden is proposing is that he wants to eliminate something called step up in basis, all right? Now, the way that step up in basis works is that let's suppose you bought an investment property. Let's suppose you bought a house for investment purposes, and you bought the house for $100,000. The year that you die, let's say the price of the house is $500,000. As the law stands right now, the cost basis for your children is going to get stepped up to $500,000. And if they sell the house immediately, they don't owe any capital gains taxes. What Biden is saying is that this loophole, this tax loophole, is costing America $40 billion a year in lost revenue. And he wants to close this. And this is how he wants to do it. So what he's saying is that same example, bought the house for $100,000. At the time of your death, the house is worth $500,000. What he's saying is that irrespective of whether or not you sell the house in that particular year, you will have taxes due on the profit, which is $400,000. So debt will in fact be treated as a sale, and irrespective, even if you don't sell it, taxes will be due, capital gains taxes will be due. Now, if for some reason, that because they are, you have this change in rule, if your income in that particular year goes above $1 million, the tax rate that you'll be paying will be 43.4%. So all your life, you would have never made $1 million, but the year of your death, because of this change in rule, you make $1 million, you're paying 43.4% in taxes. Parallelly, Chris, the second thing that's going on is that currently the estate tax exemption is 11.7 million. So what does that mean? That means that if your assets are below 11.7 million, you don't have to worry about estate taxes. But for assets above 11.7 million, you will owe about 40% in estate taxes upon death. This limit is set to go down in 2025 to about 5.49 million inflation adjusted. So what that basically means is that for folks whose net worth is higher than that, they will also owe estate taxes. And as you probably realize, a lot of physicians who worked hard all their lives, who've contributed to retirement accounts, their net worth could easily go in the $10, $12 million range, and they would owe substantial estate taxes as well. And because capital gains taxes are due, because estate taxes are due on death, according to the Tax Foundation, they calculated that some families could actually face a combined tax rate of as much as 61% on inherited wealth. And guess what? There's a lot of these taxes will be due upon death. And at that time, if you don't have liquidity to pay those taxes, you may have to sell assets. And what if it's a year like 2008 where it's not the best time to sell the assets? So there might have to be forced liquidations. So again, these are very serious issues that do have repercussions, and listeners must speak to a fiduciary financial advisor who can guide them in making the appropriate choices for themselves.
So Aadil, I'll stick with you. What are some of the estate planning strategies that physicians can use to avoid high taxes for their loved ones, essentially, at their death?
So, Chris, what they can do is, there are a number of strategies, right? And it's not one size fit all, but I'll just give you a flavor of some of the things that we are doing at Wall Street Alliance Group for our physician clients. So one strategy is that you gift assets to an irrevocable trust. So the current estate tax exemption is 11.7 million. You gift that 11.7 million to an irrevocable trust that is for the benefit of your children. All the growth in that irrevocable trust is going to be out of your estate, no estate taxes due, right? Tomorrow they reduce the limit to 5 million. You're not impacted by it because you locked in the 11.7 million, you got it out of your estate. Not only that, Chris, one of the things which a lot of people are not realizing is that you can gift appreciated assets to an irrevocable trust. When I say appreciated assets, if you bought a stock or if you bought a real estate that you have a profit on, you can gift it to an irrevocable trust and not owe taxes on the gains if you do it this year. As the proposal stands, if you do that same thing next year, you would owe taxes on the gains. So there's a window of time to do this planning right now. Now, some listeners might be listening and they're saying, okay, great, I've gifted money to an irrevocable trust for my kids, but what about me? I need income during my lifetime too. So for those folks, what we do is we design the strategy in such a way that we move the assets to the irrevocable trust, but we treat it as a sale. So the trust actually makes annuity payments for the sale, which act as income for you, and the assets are out of your estate, grow estate tax-free. Another approach, which is relatively simple to do, is essentially you're trying to reduce the pie of your wealth so that at death, less taxes are due. And one way of doing it is that you can gift $15,000 to each of your child, husband, wife combined, $30,000. You can gift to each child, get it out of your estate. It's no estate taxes are due. If you're anticipating that you're in that net worth range where estate taxes are going to be due, you could get something called a second to die life insurance policy. And what that does is that it is on a husband-wife. It'll pay the death benefit on the death of the second spouse, which is typically when estate taxes are due. And this would avoid fire sales. This would also be a cost-efficient life insurance policy to get. You could take it a step further and put your life insurance policy into an irrevocable trust. What this would do is this would keep the death benefit of the life insurance policy out of your estate. You don't have to worry about estate taxes on that. And lastly, Chris, there are strategies that we can use which involve charitable trust. And this is a topic in itself, but essentially what we're looking to do over here is your wealth, give some of it to charity, some of it to your family, and reduce the taxes. So again, like I said, there's no one size fit all. Listeners should speak to a fiduciary financial advisor who also has access to legal counsel to select which strategy is the most appropriate for them.
Okay, great. Let's just pause for another moment. I want to remind our audience that you can submit questions for Aadil and Syed by typing them into the Q&A box. And of course, you can find out more information about Wall Street Alliance Group at www.wallstreetag.com. So Syed, next question is for you. Are there any other recent changes in tax law, such as the Secure Act, that physicians need to be aware of when they're estate planning?
Yes, Chris. So Secure Act, this is something is already a law. That is not a new proposal that becomes actually law in last year, 2020. It's an abbreviation. The full meaning is setting up for the whole Community for Retirement Act. So the Secure Act, actually the whole idea was to have people more involvement in the retirement plan. But there's one provision that is actually related with the estate planning. That's something that I think people need to pay attention to, specifically physician. Stretch IRA account. We do see a lot of physicians, they actually have their money into the pension accounts or defined benefit plan or retirement account. This is their nested egg. Usually what used to happen before the Secure Act, if you die, and if your children inherit the money, they have their whole life to slowly stretch it out and take the money and use it for themselves. And but meanwhile, the money can grow as well. It's a win-win situation for everyone. Last year, because of Secure Act, that provision went away. So the new law, what it says that going forward, if you die, non-minor children inherit the money, that pension plan or retirement account, the children now have to exhaust within 10 years. Just to give you an example, in my slide, if you take a look, let's say if a physician have a $5 million into the pension plan, leave it for a child. That child could have been taking a required minimum distribution depending on the life expectancy before. Now what happened, the same $5 million goes to the child. That child has two options, either take $500,000 every year within 10 years or take $5 million at the end of 10 years. Well, you might be thinking, hey, what's the big deal? The issue is now we have to worry about paying a huge amount of income tax that is due. So again, the physician must speak to their financial advisor about, because this is already a law, it's not a proposal. And it is not uncommon for physicians to see their retirement account as their nested egg and their biggest net worth. So physicians should speak to their financial advisor about incorporating income tax planning in their estate tax planning as well.
Great. Speaking of financial advisors, Syed, what should physicians look for in a financial advisor? How do you find somebody that's a good fit for you?
Yes. So I would like to say, Chris, that when all of this thing that Aadil and me we were talking about, one thing you have to just keep in mind that it's a lot of moving parts here. It involves involving CPAs, actuaries, attorneys to make sure that all the taxes are actually done properly. Specifically, what Aadil spoke about, the estate planning, that could be very complicated. So usually make sure that the financial advisor have a team of experts in-house. So you don't have to go to 10 different places to get everything done. And the financial advisor is a fiduciary. most of the times we see a financial advisor is just a one-man shop, and they're talking about buying products. So trying to go for a fee-based advisor, a fiduciary advisor who have the actuaries, CPAs, and attorneys in-house, so everything could be done very efficiently for the physicians.
Great. Syed and Aadil, thanks so much for sharing your insights and expertise today. We'll now take some questions from the audience. Before we get started, I would like to remind you how to submit a question. You can submit questions by typing them in the Q&A box, which can be found right underneath the presentation window. So let's get right to the questions. And this could be for either Syed and Aadil, whoever wants to jump in. And if you want to answer after the other guest answered, feel free. So the first question is a clarification question on the $400,000 limit that in terms of the tax increase that was mentioned in the presentation. The question is that on all income or just earned income? Can unearned income push the earned income above the 400K for that Social Security tax?
The answer, Chris, is that yes, the unearned income can push it over the 400,000, but the taxes the Social Security tax is only on the W-2 portion of the income.
Okay, great. All right. The next question is, one of the audience members was looking for another clarification on the ETF versus mutual fund issue that I think Aadil addressed earlier. Would you mind going over that again?
Sure, absolutely. So, when you make the investments, there are two. You can select from stocks, you can do exchange traded funds, ETFs, or you can do mutual funds, right? Mutual funds are more actively managed. ETFs tend to be more passive, right? So now what mutual funds do is that, because it's actively managed, as inside the mutual fund profits are being booked, what they do is they distribute those as capital gains to shareholders. And if you own the mutual fund in a non-retirement account, then those capital gains distributions that you get, you actually have to pay taxes on it. Now, unlike, stocks, or ETFs, you don't control that. The mutual fund controls that. So in a non-retirement account, you could get substantial capital gains distributions in a good year and owe a lot of taxes. Now, if you want to own a fund in your non-retirement account, if you own an exchange-traded fund, those have very few capital gains distributions. So they could essentially give you the same type of exposure without potentially giving you the capital gains distributions. So they tend to be more tax efficient. So mutual funds, in your retirement accounts is fine, but in your non-retirement accounts, for tax efficiency point of view, ETFs are considered to be more tax efficient than mutual funds.
Okay, great. The next question I wanted to bring to the guests, to the experts, is about the Secure Act that Syed had mentioned during one of his answers. What are some of the solutions to the Secure Act? How should physicians and their financial team go about dealing with that?
Yes. So the solution for the Secure Act is actually somehow related to the estate planning solution we presented earlier. And if you remember at the beginning, I talked about Roth conversion. So remember that you have 10 years to withdraw the money from the IRA account after you pass away for your children. One option could be during your lifetime, you can do some Roth conversion. So remember, when you do a Roth conversion, when you withdraw money from a Roth IRA, there's no taxes due. So Roth conversion is a good way to handle the Secure Act situation. Usually, as a financial advisor, we recommend our client use money from the Roth IRA or a joint account and leave IRA account for the children because they can grow more because the children are younger. One option could be that the other way around. What you could do, you can actually leave the Roth IRA for the children, start using money from the retirement accounts. In this way, the Roth IRA can actually grow in the long run much more, and children can actually have more money at that time. Now, keep in mind the Secure Act is only applicable for the children who are non-minor. They're over the age of 18. So if you have a grandchild, you want to give money, one option could be that you can make the grandchild as a beneficiary of the IRA account, and the grandchild don't have to worry about the 10 years rule until the child attains the age over 18. So this could be one option. We earlier spoke about buying a second to die life insurance policy for the estate tax. You can use the same logic. You can buy a second to die life insurance policy that can be used to pay for the income that will be due from the retirement account. Or if you're charity minded, we spoke about this, that this is complicated, but one thing you can do, just to give an idea, rather paying money from your pocket, do more distribution from the retirement account. So in this way, you will have less IRA account to give it to the children. And there's no exact solution, for the Secure Act. Everyone's situation is unique. The solution could be either or, a combination of all of it, because everyone's situation is unique. So make sure you speak to your financial advisor who can actually look at your overall situation and give you a suggestion which strategy is applicable for you.
Okay, great. We also, this one's for Aadil, I think, but I think either one of you could answer it. Aadil, you had given the example of a real estate that appreciated from 100,000 to 500,000 and the taxes that would be paid on that profit that was made. The question is, if you make improvements to that property, actually sinking cost into it, is that a way to lessen that tax burden?
Yeah, so the tax at death is going to be on the profit, right? So it's basically going to be that, so if your cost basis, if you've increased your cost basis because you've made improvement, that's just going to reduce the chunk of your profit. But, the important thing to understand over here is that the year that you die, it doesn't matter if you sell the property or not. You're just holding on to the property. It's an unrealized gain. There will still be taxes due on that, long-term capital gains tax. And if your rate goes above, if your income goes above $1 million in the year of your death, then that could potentially be taxed at 43.4%.
Okay, great. Let's see, I'm just scrolling through the questions. What advice do you have in terms of dealing with financial issues and financial planning for physicians who are already retired? Is there any options or things that those folks can explore?
Yeah, so for physician, Chris, who already retired, one thing they have to worry about is the market volatility. It's very important. So the biggest challenge they're going to face, it is basically called a systematic risk. In a systematic risk, what happened then, close to at the age of 72, you do something called required minimum distribution. So in a required minimum distribution, you actually have to sell assets to meet the distribution requirement that is due. Usually it's about 5% of the value of the IRA, you have to take it out. Now, if the market tomorrow suddenly tanked, like last year happened, COVID, you will be forced to liquidate the money and take income. So obviously you lose money. So make sure the asset allocation, it is done properly. That's the most important thing. We still see, in the market, nowadays, especially social media, Reddit fuel stocks are there all the time, and we're talking about stocks going up every other day. So don't get caught on into buying the stocks. Go back to the very basic foundation, which is like have a proper diversification, because you don't have too much room if the market tomorrow goes down to recover, because you need this money to actually have a decent income. So try to focus on not in the market. We really see, as a financial advisor since last year, me and Aadil, a lot of people are coming to us with hot stock ideas. Okay, this is the stock idea I have, I want to buy and sell. This is something by all means you want to avoid it. You should go back and talk about what is your overall, what actually drives you right now, what motivates you, what is your passion, that should be, and what is your value, that should be actually the most important topic to discuss right now to enjoy your life, not about buying and selling stocks tomorrow. And a fiduciary financial advisor should be able to sit down with you and can give you a suggestion based on your overall values and give you a guidance so overall you're in the right direction.
Okay, great. Another audience question is about the Backdoor Roth IRA, and they're just looking for some clarification on the tax implications, benefits, trade-offs, any tax implications of the Backdoor Roth IRA.
Yeah, so in a Backdoor Roth IRA, all you do, you open a post-tax IRA account and convert the money immediately. Remember the word right away to a Roth IRA. So since usually what we do, we open a post-tax IRA account, put the money, open a Roth IRA, transfer the money the next day. So in this way, there's not really any gain on the profit, because if there's any gain happen, you have to be paying taxes. But since you move the money immediately, there's no taxes on the gain, and principal, there's no taxes. So, and the money grows. Now, there's one caveat to all of this. If you have any other IRA account, like a SEP IRA account, any other IRA account open, then this strategy is not going to work. It only works that if you're opening a brand new IRA account and convert the money into a Roth IRA. So what's the solution for it, for a backdoor Roth IRA? The solution is, if you have a 401k plan, if you have a SEP IRA, move everything into the 401k plan. In this way, what happened during conversion, those money doesn't count as a conversion ratio. So the solution is for this, that whoever asked the question, that is any tax ramification, there's no tax ramification there. Only tax due only if there's any profit, but since you move it, there's no taxes. But if you have other old IRA account, merge it with the 401k, open a brand new IRA account, and then convert it, so we don't have to worry about the conversion ratio.
Okay, great. We have a question about charitable trusts. The audience member asks about what are some of the, in general, the highest percent payouts that you can see from these, and they're also wondering if individual charities can negotiate over what yield they would provide with a charitable trust.
Yeah, so in a charitable remainder trust, usually we see around 20 years time horizon as an annuity payment. It's not really, you don't have to buy the annuity, you just have to schedule the payment. So, and typical payment schedule around 5%. The math is in 5% growth happened, 5% withdrawal happened, and a charitable remainder trust, what happened that scheduled payment comes to you, but every year a certain percentage must go to the charity as well. That's also 5%. That's the way we usually design a charitable remainder trust. Now, the investment usually take care of the 5% return you're expecting. And that's why usually you buy high yield bonds, or you actually buy some inflation protected product where you can about 5 to 6% return, take this money out actually as a payment. Now, in terms of the negotiation, you are the one who designed the charitable remainder trust or the charitable trust with the attorney. And this money pretty much can be used to pay any 501c approved organization. You don't have to really worry about it. As long as you can Google it and search it, their 501c, you can make the payment from the charitable remainder trust.
Great. So we have a question about 529 college savings funds. Any recommendations for decreasing taxes on these funds for the benefit of your children or grandchildren?
Yeah, so one option could be in a 529, there's some state that actually have deduction as well. For example, we are in New York City. New York actually have almost $10,000 per child. You can actually get a state tax deduction. Similarly, Pittsburgh, Pennsylvania have a huge tax deduction as well. So again, these are state tax deduction, and the money actually grows tax-free. Withdraw is also tax-free as long as you use it for educational purpose. Now, some people say, okay, what if I have a 529 plan? I don't want to use it for children. Can I just take the money out? Well, one option could be you leave it for the grandchildren and pass it on. In this way, you don't have to really worry about paying any taxes on it. Or worse come to worse, you can actually take the money out. You only have to pay taxes and penalty only on the gain. The principal remain intact. There's no penalty in it. So I think 529 is also a great way to give money to the next generation as well.
Okay,
so
great.
I would just add to that, Chris, that the 529 is a fantastic way to save for children's education, because like Syed explained, it gives you, in some states, you actually get the deduction for the contributions against the state taxes, but the growth in the 529 is tax-free and deferred, and the withdrawals are tax-free as long as you're using them for qualified education expenses. Now, a lot of times we could set it up on a monthly type of a contribution, so that the burden when the kid goes to college is not huge. It's a great vehicle. It's a great tax efficient vehicle to plan for education.
Okay, great. Sort of a more general question is that not everybody gets started on their retirement and financial planning as early as they should, and I'm wondering if there's anything that somebody who got a late start on should do. How do you get started on financial planning if maybe you started late?
Yeah, so I will start, and Aadil, you can come in as well. So usually we recommend for clients to save as early at the age of 30, save at least 20% towards retirement. That's what we recommend. But in a physician community, it never happens. They don't actually start to make money until the age of 45. And a cash balance plan, retirement plan is one of the best way to actually preload or pre-fund the amount of money that the physician usually miss. And as I mentioned, even if you are young at the age of 45, you can contribute with the salary of $260,000, almost in the range of $100,000 ballpark in a cash balance plan, and that will give you some cushion and some catch up to do that you actually miss early in the year. And this is very common. We see physician community. That's why cash balance is very popular.
I would just reiterate to what Syed said, and I would say that, a lot of times when we deal with physician, invariably what happens is that people start focusing on financial planning a little later, in their late 40s. Ideally, you want to start as soon as possible. And a lot of times people are just focused on stocks. What you really want to do is, your needs are different from someone who is making a little bit of money and who's just investing in stocks online. You have more comprehensive needs. Your needs are have to do with asset protection, lawsuits. Unfortunately for physicians, that's a big risk. Tax planning, estate planning, making sure your wealth gets transitioned to the next generation properly. So what you really need is a fiduciary financial advisor. Just like you're a fiduciary, you need a fiduciary financial advisor who can sit down with you and make a financial plan for you, which covers the whole 360-degree. And then that would guide what investments should follow to cater to that financial plan. So that, in our opinion, is the best way to start off. And that's the process that we've tried to stick to since we've been doing business.
Great. Thank you to the audience for all the great questions. That's the last question we have time for today. I want to thank